Good morning, students. Welcome to Sai CA Coaching Center, and this is CA M.S.Swaminathan with you. Students, in furtherance to what we have learned till now, let us move on with the next part of the syllabus in today's session. The next important concept, which is pricing policy. Well, it is absolutely critical for any firm to ensure that it has an appropriate pricing policy which is well documented. The reason being, it is the pricing policy which will basically ensure that the business is able to survive in the long run by making or by earning sufficient profits such that it has enough money even to replace its existing capital investment. I mean, replacing the fixed assets and continue to be a going concern. So it's very critical to have a pricing policy which is well documented, and that can be done only if the overall objectives, the strategy of the establishment has been clearly or well understood. Now, the pricing policy, the relative price structure should basically help the organization by trying to provide it with an incentive to adopt improved technology, avoid kind of a discord in the economy, adverse effects on the rest of the economy, promote exports, encourage your utilization of resources in an optimal manner, etc., etc. Now, if someone were to ask you, what probably list a couple of factors which would have a bearing with regard to setting the price for a product. Now, the immediate answer typically would be the cost of a particular product impacts its price. This is something that would be, I think, stated by most of the students. But then if one takes a step back and try to think a little more, is cost only the most significant factor which has to be considered in deciding the price of a product? Well, cost certainly is very important, but then there are certain other aspects which are external, something like the extent of competition prevailing in the market. Well, if the market has fierce competition, then one will have to consider that as well in terms of setting your price. That might drive the price setting exercise. Two, the taste, the behavior, the preferences of the customer. That also is a key aspect to be borne in mind in setting the price of a particular product, correct? For example, if you open a restaurant and you have opened a restaurant today and you find virtually only few customers are walking into your restaurant, but then a restaurant that is right opposite to your shop on the street has a huge number of customers flowing in, and you try to sit back and analyze what is the factor that is differentiating the two. For example, you have not been able to arrange for an air conditioned room to provide customers with food. That could probably be something which is relating to customer behavior or taste. So several factors are there apart from cost, which can also play a key role in determining the price of a particular product. Now, when we talk about this price, there is a concept relating to price customization, implying the price of a particular product can be tailor-made to suit the requirement of a particular situation. Now that can be analyzed in 3-4 different ways. For example, one, it could be price could be customized based on product line. And depending on the capacity, the features of the product, you could quote a different price. For example, it could be a cell, a mobile, which is able to have an alarm. I might be giving you a just weird example. Maybe a mobile which has an artificial intelligence mechanism will obviously be quoted at a different price, and so on and so forth. Two, price customization can be done even based on customers' past behavior. For example, those customers who have been historically prompt in making their payments could be given higher discounts compared to others. Now, based on demographics, meaning the examples given in the study material are very good. Senior citizens could be charged a different price, others could be charged a different price. We find that banks provide a higher interest rate to senior citizens vis-a-vis the normal citizens, non-senior citizens. And then you have, based on time differential, the longer the duration you associate yourself with me, a lower price will be quoted as the shorter the duration of your association with me, higher would be the price that I would quote. Something like if a student wants to undertake hourly classes, then the rate would be different, would be much higher rate. But then if the student were to join or enroll for a class which lasts for 3 months or 4 months, the pricing would be different, something like that. And then we move on to another logical concept, which is price sensitivity, implying what would be the impact on customer behavior, or what would be the reaction of a customer in terms of a change, delta, if price is altered to a particular extent. So if I try to experiment by changing the price of a particular product, what would be the delta effect or the change in the behavior of the customer is what is analyzed by way of price sensitivity. And there is a gentleman by name Nagel who has identified 9 factors that contribute to price sensitivity. A chart is given, quickly going through each of them. Unique value effect. Of course, the more and more unique your product is, the lesser and lesser will it be to price sensitivities. Customers will be less sensitive because it is unique. Substitute awareness effect. If customers are aware that more substitutes are available in the market with respect to your product, it will be more price sensitive. If they are not aware, it will be less price sensitive. Difficult comparison effect. Though there might be products which are substitutes available in the market, if the customers are going to find it very difficult to gather that information, then obviously they would not be able to compare, and therefore it will be more price insensitive. Total expenditure effect. This point and the next point, one has to understand it quite well, okay, though it's simple. Total expenditure effect. If a person is actually earning 1 lakh rupees a month, and a particular item of expenditure that you incur every month costs you only 10 rupees, well, you're not much bothered about it, because 10 rupees on a 1 lakh rupee base is hardly anything. Therefore, if the price of that particular item is going to go up from 10 rupees to even 15 rupees, you may not be much bothered about it, though it's a 50% increase. Why? It's a very small proportion of your income. The end benefit effect. Now here, read the sentence. Buyers are less price sensitive where the expenditure on the product is low compared to the total cost of the end product. There is a big difference between this item and the previous item. Here we are not linking it to the total income of the individual. The individual goes and buys a product which totally costs. For example, let us assume I buy a car which is worth 5 lakhs, and one item which is to be bought for making the car costs you only 50 rupees or 100 rupees. That is what here we are trying to discuss. End benefit effect. Buyers are less price sensitive where the expenditure on the product is low compared to the total cost of the end product. So we are referring to the price sensitivity about the 25 or the 50 rupee raw material or product required to make that car which costs you 5 lakhs. Then there's a shared cost effect. Now, if I were to go to a shop and eat a cake which is going to cost me 5,000 rupees, as an individual, I would be really worried about it if the price goes up from 5,000 to 5,500. Whereas, if 100 of us were there to eat the cake, and the price is increased from 5,000 to 5,500, doesn't make a big deal to me. Therefore, I would tend to be more price insensitive there. Depends. Sunk investment effect. Actually, this is the reason why I explained each and every point. Else, I might have said, please do self-study. A sunk investment effect, what does it mean? Sunk cost we have understood in costing as something which has already been incurred and nothing can be done about it. You can't unwind that cost. Now, the concept is explained in the study material as price sensitivity is low in products which are used along with assets previously bought. Please read it one more time. Sunk investment effect. Price sensitivity is low in products which are used along with assets previously bought. Now, just go back and look at the concept of sunk cost, a cost that has already been incurred. Now come back to this sentence and see the last phrase with assets previously bought. So sunk investment refers only to the last part, assets previously bought. Now let us assume that I have already purchased a laptop, okay, and that is with me for the last 4 years. Of course, it is going to be something which is outdated in the current scenario. But then I have no reason good enough for me to change the laptop. My laptop is functioning absolutely well. Okay, it is able to satisfy all of my requirements. There is no necessity for me to junk it and now go for another laptop, which might cost me an incremental 25,000 rupees. Though, please bear in mind, money is not a constraint. I have enough money to go and purchase the new laptop, to exchange the old laptop and get a new laptop. Now, read the sentence, sunk investment effect. Price sensitivity is low in products which are used along with. Now, with regard to my earlier laptop that I have purchased 4 years ago, if I need to now buy some item for that laptop, okay, let's assume that the item which I have to buy, a cover, okay, just as an example, a cover for that laptop, which used to cost 100 rupees, but now is being priced at 150 rupees. The price has increased by 50%. Now, logically, we will tend to think if the price shoots up by 50%, the customer typically would say no to that particular product because it costs too much. Now, what are we seeing? We are not linking that 150 rupees to my level of income, but we are linking it to the fact that that particular cover is what will suit my earlier laptop, which is outdated now. Now, if I say no to that cover, let's assume that my laptop will get affected because of not being covered appropriately. Then I will have to go and incur now a fresh expenditure worth maybe 60,000, 70,000. Now, would I prefer to incur a fresh expenditure of 60, 70,000 or just spend a 150 rupees wherein there's an extra 50 rupee element because of the increase in price which I have to pay? So I would rather take a view. It is better to spend this 150 to take care of my earlier product. This is what the sunk investment effect. I hope it is very clear to you. Price quality effect. Higher the perceived quality of the product. Underline the word perceived. Huh? Well, there, in English we have a phrase, looks are deceptive. Ignoring that for the moment, higher the perceived quality of the product, lower the price sensitivity. If customers tend to think that the quality that you are delivering is much, much higher than what your competitor delivers, they wouldn't mind if the price of your product is going to be increased by some amount. Then the inventory effect. If a particular item if the product cannot be stored, the buyer will be price sensitive, of course. But whereas if the product can be stored, I would not be much bothered about it because I would purchase and stock it now itself. Okay, in the current day scenario, this assumes a lot of significance. Moving on from there, with regard to pricing as to how to measure the price sensitivity, etc., some type of a controlled experiment can also be undertaken by trying to go to the market with your different products, competitors, brands, and trying to ask customers for the price that they would be willing to pay if the price of the product is being changed by some amount. How much would they be willing to buy? You could do it that way as well. How much of quantity would they be interested in buying if the price of the product is being increased by 5 rupees or 10 rupees or 50 rupees? So this is one way of trying to gather information about to what extent will price be sensitive. Rather, let me put it this way. To what extent would customers be sensitive to the movements in prices?